Hey there, it is Phil Ratcliff, and thanks for joining us for another one of our broadcast videos. Today we're going to be talking about trading stocks, ETFs, and mutual funds, kind of the basics. And, if you're joining us, appreciate you tuning in. Don't think this is going to be some advanced thing. And of course, as always, we are financial planners and advisors, so it's always going to be through the lens of looking at people that look at investing and a holistic approach, right? Not just trading and the specifics. I mean, if you really want to get into technicals and stuff, there's a whole lot better information out there. But I don't want to turn you off either. I think there's some valuable information that I'm going to give to you today. And again, thanks for tuning in. So let's think about something. And I think whenever you approach this subject, you really have to look at investing versus like speculation or speculating. And I actually found this little chart and I like it because it actually breaks it up into three things: investing, speculating, and gambling. Okay. And there's so many times where I've run into people and they said investing is just gambling. And the way that some people do it, absolutely that is true. I think people like to cover up doing their gambling in a more sophisticated way, right? But investing done right is not gambling, and there is this middle ground between those two that is speculation. I think that's like the pretty word for gambling, but maybe a little bit more informed, where it's getting closer to investing. But let's break this chart down a little bit. When we look at the odds in gambling, they're unfair, right? They're built to favor the party that's making a business out of it. Or if it's someone that likes the thrill of it, they like the enhanced risk, which sometimes offers a ridiculous payout, but the amount of times that it fail are just not worth it, right? And so if somebody's going to gamble, the odds are not fair. And what is that person looking for? They're looking to have fun. They're looking for that thrill or whatever the emotion is from it. Okay, I don't know that people really try to break it down into a tangible intellectual thing when they're looking to gamble. But really, these are true. What should be your ideal profile? It means you have the money to waste and you're looking to use that money to have fun. And if you're lucky, you'll come out ahead. Most of the time, or if you average it out and you do it enough, you'll lose. Okay. So can you lose money in all these things? Absolutely. That's absolutely true. Speculate, or let's go the opposite end and do speculation in the middle. Investing, the odds are favorable. If you do it well in enough times when you're investing, you will come out ahead. Is the whole point of investing. It's almost the definition, okay? That we are looking to invest in enough things or in things that when you diversify them together, that if I do it enough times, even though you could absolutely lose on any one of those things, it should come out to where you win, okay? But not hugely, right? You're going to make a profit. And if you do that well over time, the whole point of investing is that the exponential or the compounding power of that growth makes you do really well. Okay. And this is passive investing, which means that you don't have to do anything. You can hire someone like us to do it for you, and this money works for you. If you start a business or you have a rental property which you put in the labor to, and those things are successful, there's almost nothing that's going to beat that rate of return, because that is an active investment. You're putting in work as well as having capital involved. Okay, so investing. So you're looking to build wealth, steady returns, and you'll probably do fairly well. Can you lose money on any one of those investments? Absolutely. And people that put too many of their eggs in one basket, sometimes they lose a lot, and then they're jaded for the rest of their life and think that you can't win on investments. But if you do the smart thing, do your research, put your eggs in different baskets, and you average that out over a long period of time, you should absolutely make money. The odds are in your favor. Speculation is kind of a mixture between these two. You have some expertise in the field. You are really putting a more concentrated bet on something that has a riskier payoff, right? It could be really high. It could go for broke. Think of putting money into a company before it goes public, really believing in like this biotech thing, and you're a doctor and you understand the science behind it, that's a pretty good informed bet. Could it hit a stage 3 trial and just totally fail and boom, you got nailed? Absolutely. But if you know behind the things, you could say, hey, I really have a high confidence in this. It could get through, right? You could be saying, hey, right now it's April 2021. Coinbase just went public, and you really believe in cryptocurrency, and you say, listen, this is kind of a risk, but I really believe in cryptocurrency, and Coinbase, or maybe Gemini, or somebody, Binance, goes public eventually. I don't know, but you say, hey, I really believe in this thing, and this is one of the first custodians to really go public. I think they've got a bright future. You're still speculating to put a lot of money into that company, but it's an informed decision because you already invest in cryptocurrency and you believe in it and you understand the underlying technology and the use cases. That is speculation. But still a lot more informed than gambling. So let's push on. You understand the differences there, right? So when we get into, hey, we're going to invest, we need to understand that investing is a business. We're providing capital to other businesses. Okay, so we have to make an informed decision to say, I want to give them some of my capital so that they can use it to grow it into more capital, because they're going to provide utility to other human beings, right? In some way, shape, or form. You could say they're going to provide utility to other companies, but at some point, companies have to give utility to human beings because that's the way it works. Maybe in the future, we'll have AI and autonomous vehicles and beings and what's so, and you could say you could give utility to other things. But for right now, at some point, it has to come down to human beings. So once you realize that, you're in the business of providing capital to other people. So first of all, you have to save up some money or have some money to be able to do that. Okay. And once you do that, you have this responsibility to yourself or to your family or to your business, whoever you're investing for, to use that capital wisely, to let other people use that capital to work for you. This is your business. You're hiring people. Okay. So when you're thinking about what you're doing, you have to realize, what's my time horizon? Am I going to invest this money and I need it next year? Or am I investing this money and I have a 50-year time horizon because I'm 20 and I don't need this money until I'm 70? And most people are somewhere in the middle, but you have to understand your time horizon, because the longer your time horizon, the more aggressive, maybe sometimes speculative, you can be if you really believe in the long term of it. Because, people have been talking about flying cars since the Jetsons. So what is that, like 30 or 40 years? Do we have a flying car? No. I mean, now I guess they're getting some of those. I've seen in like somewhere in like UAE or what, so they're making almost like the drones that are like cars, right? Maybe they'll be able to do it, but we need better battery technology. But if you would invest in that, that'd be a horrible investment, way back when till now, right? Even though that technology would be phenomenal and maybe still coming, right? So your time horizon very much matters in terms of how long you're going to invest. If you're going to invest for your retirement and you're 30 years old and you've got 30 years to go until you retire, and then you're going to need to live off of that money for 40 years, you've got a 70-year time horizon. If you sold your house and you need to invest it for 1 year, and then you're going to buy another house down in Florida, that is a very different time horizon. I don't care if you're aggressive, you need to be fairly conservative with that investment. If not, maybe even being FDIC with it and taking these horrible low interest rates, even though for a lot of people that's really unpalatable. Okay, so next you need to decide your risk tolerance. And so risk tolerance just says, how much risk am I willing to take? It's like, how much can something go down that I won't want to sell when it's down? We actually use a pretty cool tool called Riskalyze. You could try our full free tool right here on our main page if you're here on rebelfinancial.com, and just click here on this free portfolio analysis, and it'll bring it up. And it's fairly simple, but it'll give you a number between, low single digits all the way up to 100. Of course, the higher, the more aggressive. you are, and you just answer a few questions here, and it will spit out a number and kind of give you, based on how much you're willing to lose versus how much you're willing to gain, like how aggressive or conservative you should be. Okay, risk tolerance is very important because all things being equal, I know the more aggressive people are, if they were a computer, the more money they would make, right? But we're human beings. And if things lose below a certain level, you hear these people on CNBC or your peers at work or a brother or sister say, well, you should get out of the market. I got out days ago. And you're just like, oh my God, I should get out now because it could go down double more than what it is. But again, what are you supposed to do when you invest? You've probably heard this. You need to buy low and you need to sell high. So if things go down and hit you to your panic button to where you sell low, you failed. You failed. You should have just kept your money in the bank and never invested from the first place, in that example. So, financial professionals like me and other financial advisors, what we try to do is help people say, how aggressive can you be that when the metaphoric crap hits the fan, you won't freak out and sell. Okay. And ideally, you will have the courage, if you have, and hopefully you have money on the sidelines in cash, or if you have a diversified portfolio with lots of different eggs in different baskets, you'll be able to take from the conservative or the cash position and buy more of the things that we believe in the long term on sale, right? So risk tolerance is very important, even though I know a lot of people probably scoff at it when they're younger. And then you need to have an investment strategy. I mean, what is your investment strategy? I mean, if you're younger and more speculative with a pot of money that you could absolutely lose and you want to invest for the long term, then what's your strategy? Are you going to invest in technology? Are you going to invest in long-term just equities? Or do you want to save up and buy a rental property? If so, where are you going to do it? When are you going to do it? How long are you going to hold it? When do you know when to sell if things are like frothy? Or if things were to really go down, how long could you hold on if you needed that money? Would you have the opportunity to double down if you really believed in it, right? And there was just a good opportunity, but you lost a lot of money on the way down. Like, you need to have a strategy and think about these things. You shouldn't just go jumping in, okay? And know why you're investing in it. And so this matters a lot, I think, because human beings tend to get attached to things. And so they'll say, well, I invested in something. I thought I was going to work out. It didn't, but I put it in at $100 a share. Now it's down to $65 a share. I would not buy this thing again. I don't like it anymore, but I'm not getting out at least until I get my money back and it goes back up to $100 a share. That is a horrible mentality. Like, if you wouldn't buy it again at $65 a share and you don't necessarily believe it anymore, like it's going to go up, you need to get out of your sunk costs of where you got in and really think about, like, if I would invest in it again, you should take out what you've got and invest in something that you believe in again. Sometimes that'll work, sometimes it won't work. But again, don't let your sunk costs and your emotionality being attached to a certain amount of money or to a certain thing really hurt you. I know people all the time that they'll buy something and they love it and it's done great and it's just at ridiculous heights, like maybe Tesla when it went over 1,000, they won't sell it, but they know good and well it's way ahead of itself. And if I sold it, I'd have to pay all these taxes. But you know what? If we make money and we get to keep all that extra money, if we have to give some of it to the government, so be it. Like, sell at least a portion of that, pay the tax man, and then when it comes back down to reasonable periods, rebuy into that. So again, I'm not a proponent of short-term buying and selling, but again, I mean, sometimes the markets are irrational, and sometimes you have to give Mr. Market what he wants. If he wants to pay you 3 times worth what something's worth, sell it to him. If he's willing to sell you something at 50 to 75% off, buy it from them. This is how the markets are more efficient and how you can benefit from the markets, being that we are human beings. Okay, so next thing, let me just real quick, I'll share this with you. This is just from a fund that I see lots of people buy these days, especially since the S&P and the NASDAQ have just done so phenomenally the last 5 to 10 years. Great fund by iShares, IVV. just investing in large companies, mega companies in the United States. But anyways, I just wanted to show you this little thing by Morningstar here. And if you're going to start to invest and do things, like start to learn these things. What's NAV, net asset value? If you look at some of these charts and you say, well, I really don't understand what alpha is. Google it, look it up, look at Investopedia, figure some things out, and little by little, like increase your knowledge. I mean, with the internet and YouTube and everything at your fingertips, little by little, you can how are things are expensive or cheap and measured in different ways. How are these things broken up? I didn't realize, I thought this was an index that was diversified. How is it so big into technology? Right? And when you look down here, you say, oh, well, sustainability or ESG, environmentally, socially conscious, and good governance. I didn't realize that this had just a mediocre score, and that I really care about the environment and about racial justice and social progress, etc. Maybe I can find something that invests in similar type things that does that. And you say, wow, look at this. I mean, look at this. The S&P 500 is super tech growth heavy right now. I mean, look, Apple, Microsoft, Amazon, Facebook, that's Google, Google again, Tesla, Berkshire Hathaway owns a ton of Apple. There's a value company, JP Morgan Chase. But anyways, learn some things, right, about what's in things. And if you don't know some terminology, little by little, look up things, increase your knowledge. This is part of your job now if you have passive capital. Okay, so let's move on. Free trades, right? Everybody's talking about free trades. I don't know why I'd invest in a mutual fund or do any of this. I can trade online for free from Robinhood or JP Morgan or some of these companies that weren't even around a year ago. There's all kinds of things now. Hold your horses. Free trading is a misnomer. These people are not out to run nonprofits. They're making money off of you. And if they said free trading, they're probably making more money off of something else. So you look at some of them, they're making money off the spreads, which means that a lot of these traders pay these custodians to route their trades to them. So if you say, oh, I want to buy, say I've got it up here. We'll go over it in a second when I'm actually looking through. I want to buy ARK, which is this, technology ETF that's really popular. And you put that order in as a market order. These guys are, fractions of a second faster than you. They see your trade and they go buy it cheaper and then give it to you. And they're doing this all the time. So the higher the volume goes, the more the people trade and do these market trades. They're just making money off of you and lots of other people on the spreads. So it's not free. It's just hidden now. It's obscure. So there's a lot of people like me that say we don't like commission-free trading. It's going back into the gray area of people not understanding or being able to see what they pay. I'd rather pay, $1 to $10 a trade all day long, knowing what I'm paying, versus people telling me it's free. So you got to be careful with that. I tell people all the time, never use market orders. Okay, I mean, you are just sitting out there on a silver platter for these predatory traders to take advantage of you. If you want to understand the concept behind that, read that book, Flash Boys, and they'll lay it out in a story that's awesome, and you can understand a little bit better. So anyways, so let's look at this. So this is just a play account that I have, and you're saying, hey, I wanna buy something. So we talked about this ARK, this exchange traded fund right here, and we say, you can look at it, do all your analysis, make sure you understand why you buy it, that it's a good buy, generally that you want to hold it for the long term. Short-term trading, you can do it. You can buy on technicals. This is not what this video is about. I'm not an expert at this. I manage hundreds of millions of dollars, but I will never do this. But there's lots of stuff out there about it. If you believe in it and you want to do it, it's your money. Go for it. Research this stuff. Find somebody else that's an expert into it. I will tell you, when they've done a lot of the expert analysis from academics over long periods of time and averaging things out, technical traders tend to underperform the indices on a risk-adjusted basis, by about 1% to 2% per year. So after all that work and expertise, and a lot of these guys are and girls are geniuses. But the statistics of it is you're not going to beat the market. Now, can you be an outlier and way outperform? Absolutely. Can you be an outlier and get your butt handed to you and you're the smartest person in the room? Absolutely. So, play this game, go for it. Don't recommend it. Okay. So anyways, let's look here. So what we were talking about. So in these apps, and this is one of the things that's very deceiving. I actually really like a Robinhood. I started my Robinhood account to just kind of play with it, even though I have lots of custodians for my business. But you got to be careful, man. They make all their money off of selling you to other people. Okay. And so when you go in here and say, I want to buy this, I want to buy that, and you say, how many shares do I want to buy? And you type it in and you say, boom, put this order in. You just threw a market order. The predatory traders are going to eat you up. And they might just say, oh, it's fractions of a cent. It hardly costs you anything. Come on. Like, they gamified this. They made it to where you're going to trade a lot. And as you make more money, you're going to trade more. It gets bigger and bigger and bigger. It's not a good deal. So make sure in whatever one that you have, you can see there's all these types of orders in here. The one that is the most pertinent for most people is going to be this limit order. Okay. So use limit orders and you say, all right, this price is 121. You can look back through time, look at like some of these reports that we are looking at, think about what you think the value of this company or this fund is to the future and say, hey, listen, I would be willing to pay, $110. You can do cents, however granular you want to make it. And I want to buy this many shares, times it out. Say I wanted to buy, 50 shares of that. And then mostly what I do is say good deal canceled. Now, you would think that'd mean forever, but most of them only go like 6 months out or what's out. Okay. And then pop it in. And then you could say, yes, I would like to do it during extended hours or not. And then, pop it in. And then that order will stay there and execute when it's supposed to be executed. So once it hits that price, it will execute. There are other types of orders. Again, I'm not going to get too sophisticated, but limit orders are generally the best for most investors. There are going to be cases when you want to throw something at the market because you want it as fast as possible. There are going to be cases when you want to put stop loss. There are going to be cases when you have stop limit orders. I'm not going to get into all these because it would make this video crazy long, but for most people, limit orders are great, whether you want to buy it, whether you want to sell it, so like sometimes I'll even have like kind of straddle orders out to say, I own some of this, I would sell it at 180, I would buy more at 110, right? And so then those orders can execute. Now again, you can only buy so much or have so many limit orders out at a time if you want to buy or own lots of different things. So you've got to be selective in what you're doing. You can use margin to extend that. Margin means borrowing on the stuff that you already own. But be very careful doing that, okay? Because if you overextend yourself too far out, then if the market goes down too much to where what you owned before could support a larger portfolio, so you're actually borrowing money. That's what margin means, borrowing money from the broker dealer to buy more securities. If you have a general sell-off of the markets, they could force you to either inject money immediately or sell things at a loss. And again, what's our goal? We want to buy low and sell high. So if you get a margin call, that's what it's called when they make you put more money into there or they just force sell your stuff off. And a lot of times people don't have more money when bad things are happening. Then they will force you to sell low while you are already leveraged up. It will multiply your losses hardcore. Okay. So you got to be really careful about that. Okay. So let's move on. So this is an ETF. ETF stocks, very much similar. You can do market orders, you can do limit orders, you can do stop orders. There are multiple types of orders. Generally, you want to use limit orders. You get into mutual funds, and with mutual funds, I very much like mutual funds because you're hiring professionals. They're pretty old school. I think the worst thing about them is that they settle at the end of the day, and the markets over the last few years have become very, they move a lot sometimes in between days. And so you're like, I want to buy this. The markets are down a lot. Or you have something that helps you keep track of your stuff. You see it's down a lot and you need to buy more. Well, you put your order in the next day after your software told you what it ended that day. well, the next day it might have rebounded all the way back up, right? So you're like a day behind with mutual funds. The good thing about mutual funds, you have professionals, right? So you don't have to worry if the mutual fund's doing its job right about the predatory traders and stuff because they're doing that sophisticated trading for you. Really, that's where you're going to find more than not the best sophisticated investment professionals, right? So they're managing big portfolios. They have a team of people working for you. So I want to invest in small companies and emerging markets. Like hopefully they're going to put boots on the ground and go make sure that you're investing in a company that's legit, or that you're not helping to build an apartment building that's empty in China, right? Like they're going to make sure that these things are happening. So again, that's not too broad stroke. They're trying to make active managed ETFs, and there's a lot of. I'm not going to get into too much detail. They're trying to make like non-transparent ETFs so that more active managers will want to do it without having to share their secret sauce or recipe. So hopefully there'll be more coming to ETFs. But I do like mutual funds a lot. But again, they're a lot easier to trade in terms of you just buy it, and then so when you put in your order at the end of the day, they'll calculate their NAV, and if you had your order in before 4, then you're just going to get it at that NAV for however much you wanted to buy, right? So there's no rushing or worrying about the spreads or anything like that. It's just you're going to get it fair price. You have to work with the fact that it doesn't trade intraday, so you're gonna have to wait till the next day. And if you're looking for triggers that sometimes don't happen to the end of the day, then you're going to be at the next day, so you're just going to be behind. But for most people that are long-term investors, that's not a huge deal. And if you're looking for that active management and that trading expertise, could very well be overcome by that. Now, the thing that does get complicated or tougher with mutual funds is that there are share classes. So you can buy A class, B class, C class, investor class, I shares, R shares, etc. So for most people that are doing it yourself, you kind of want to look for the investor class shares. So investor class shares are going to be more expensive because you don't have a big economy of scale with them, but they're going to be load waived. With A, B, and C shares, they have a loads, and loads are there to pay commission-based advisors. So with A shares, they may have a load of somewhere between 2 to 6%. Okay, so if you hired an advisor with a broker dealer that sold you an A class share, then generally they're going to get paid that 2 to 6%. Okay. And if you invested $100 and it was 5%, 95 of your dollars go into the fund, right? And then they have what's called 12B1s, which kick back maybe 0.25% every year thereafter. Okay. So if that's the way that you pay for your expertise and you're happy with it, great. If you are DIY in it and you're paying loads, that's crazy town. Don't do it. Okay. B shares, generally you won't find B shares anymore. The regulatory authorities have gone after them a lot. But generally with those, they'd have much higher internal management expenses and a penalty if you sold them within 5 years. And then the companies would pay an extra load to your advisor or commission. With C shares, so now it's generally A or C shares with the loads. Then basically you don't pay anything up front, but you pay a penalty if you sell it within a year. And then the advisor gets like a 1% kickback or what so. So generally, if you're DIYing it, don't buy the A, B, or C. Okay, buy an investor class share. Inside your retirement plans or what so, you should be able to buy institutional or R shares. Most of them are R shares because they're retirement class. Generally, the higher the number on I shares, the better. So if you get like a R6, those are usually what's called clean shares. And then institutional, if you have $1 million or more, depending on the fund company with that fund company, then you can buy institutional shares. Or if you invest through someone like us, then we kind of pool our clients' money and we're allowed to buy iShares for our clients. And, maybe that saves them, 0.25 to 0.5% per year. So if someone was paying us, 0.9% and we were able to get them cheaper shares than they could get on their own, maybe we save them 0.3 of that percent. But again, it is more expensive to use a professional. So on that note, moving past the individual securities, use professionals. When necessary. So, look to get an accountant when you need tax help. I mean, if things are going really well for you and you have passive investments and you have earned income and you have the side business and you have a spouse, then get an accountant. It's not that expensive. Make sure you do things right to kind of have that insurance of someone to help defend you and to look for opportunities, etc. Get legal help. Make sure you've got the right entity selection. Make sure you've got your estate planning done well. When you get a really complicated tax issue that's beyond the CPA that might involve case law and what's involve a tax attorney. These things you don't want to scrimp on as you're successful. Some of it's insurance, and a lot of times they can provide a lot of insight and provide advice and opportunities that you wouldn't have come up with. And of course, a little self-serving, but financial advisors, right? We help people with the planning side of things and coordinate some of these different professionals with things that people don't want to be speculative about, or really want to be able to focus on their family or their business or their career. Then we make the diversified portfolios trade for you. And make sure that all the sub-selection trading, et cetera, is done well. The one caveat I would mention there is make sure you hire somebody that's always a fiduciary to you. We're fee only and fiduciary to all of our clients. I really like fee only, which means that we don't take commissions or kickbacks from anybody. We only take what our clients pay us. So I would recommend fee only and fiduciary, but at a minimum, get somebody that's a fiduciary. It means they have to look out for your interests before their own. It's really important. And the majority of advisors today are not fiduciaries all the time. Some of them try to obscure the line and say, well, we're a fiduciary when you have a managed account. We're fee-based. It's not the same thing. Okay? You want somebody that's a fiduciary to you all the time. They have to always look out for what's right for you, not when you're in a certain type of account or when they're talking to you about this and not that all the time. Okay. So the last thing I'll end with on this is have fun. Enjoy the fact that you're successful if you have this discretionary income to be able to invest in. Invest in things that excite you to a certain degree. Again, don't get to gambling or speculation. That you think will make the world a better place, that are good investments. Be a good steward of the resources that you now have, whether it's from your own sweat, blood, and tears, or whether somebody cared about you enough to have done good in the past and leave you something. Let's all be good stewards. And if we help take care of the world and push our resources towards things that make things better, that have utility and help our fellow man, then we will continue to prosper together. You will have more from these passive investments and we'll succeed as a species. So just be careful. I mean, if you're really doing it for thrills and the emotionality of it, it's probably dangerous. And right now, when the markets have done so good for so long and we had a really significant recession and it just went away in a blink and a lot of people stuck a lot of money in and almost everything's done well, it's really easy to just think that investing is easy. If you're into the crypto mania, I mean, I have invested and mined crypto for a long time. I've made money off of it, etc. I'm not criticizing you, but be careful. This is some of this is like free money in the short term. You need to be careful with what you're doing, or it'll be gone in a blink. So anyways, thank you so much for tuning in. This ended up being a lot longer than I wanted it to be. I hope this helps some people. As always, we're here. Join the conversation. Ask us questions. We'd love to help and be a part of your success. So have a super finish the week. Look forward to seeing you again in the future or talking to you down the road.